welcome to your Financial Legacy podcast. I am your host, Maria Ellis. On every episode, I will bring you my perspective and the perspective of my guests on financial planning and financial legacy topics. Here at the Financial Legacy podcast, we're changing lives one person at a time. To help you create and enjoy your financial success, connect with us at financiallegacy.live for your complimentary consultation. Today, we would like to talk about tax strategies and investment structures. And we're very pleased to welcome our very special guest, Richard Wilson, the founder and head of Family Office Club, the largest membership-based family office association with over 1,750 registered family office members and 25 live events per year. Richard, welcome to the show.
Yeah, thank you. Appreciate you having me here.
Tell us about your familyoffices.com and what inspired you to create it.
Sure. So 14 years ago, I created Family Office Club to connect family offices to each other, to help myself really learn more about the family office industry and to share what I was learning along the way. So since then, I've written 14 books, and I've produced 2,300 videos, and I've spoken at 250 events in 14 countries. And every time I meet with several dozen family offices or hear 25 of them speak on stage at a single event, you always pick up some new insights on kind of a view of the forest, but also where the industry is headed, what they value, what they're trying to allocate capital to right now, but also things that have been true the whole 14 years, but it might take you 3 to 5 years, 7 to 10 years to pick up on some of the trends. After you hear about them again and again, you realize it's a really long-term macro trend and not just some short-term fad in the industry.
And really what's interesting is that there are so many different countries and diverse needs and opportunities that really gives us a very comprehensive outlook as to global what's happening on a global basis. So that's very rewarding, and you bring a lot of value to potential investors in those countries and globally, really. So the topic today is going to be about tax strategies and investment structures. And so tell us why that is important in terms of establishing best practices around tax planning when you're doing investments.
Sure. So what I found is that most people raising capital obsess and focus on just finding an investor. And they think once I find enough investors, somebody's going to invest. And what I find is that most investors are asking themselves, who can I trust? And they just invest based on who they trust, which is a good first screening criteria. But they often only invest based off of referrals or what their friends and family have invested in, or which is a good thing, they invest in the niche they know best. What I find is that both investors and people raising capital can move with more conviction and de-risk their investments and get more done by structuring things more tax efficiently. And almost every investment can be done in a way that's highly tax efficient, or where you just don't even consider taxes and you just put the deal together and you just invest the money and no one even discusses taxes. Everyone knows that you invest money to protect it and hopefully get a return, and the taxation of the money highly impacts the return of the capital. So there should always be a discussion around what planning beforehand, what actions during the investment, and what actions need to be done right before you exit the investment to minimize taxation.
Yeah, because it's not just how much money you actually make, but A, are you able to keep it? And B, how can you maximize that overall return? So that's very important. So can you mention 1 or 2 examples of deals that you have seen when there has been this tax planning and proper efficiency?
Sure. Yeah. So 2 of them were deals I put in money myself recently. One of them was a dental clinic. We structured the deal so that I would get a gross revenue royalty every month going forward until I get 1.5 times my money back. But importantly, when I put my money in, there was a chance to have bonus depreciation on equipment that had been put in place inside the dental clinic. So I was able to get dollar per dollar 100% write-off of the money invested. So I put in a couple $100,000. That couple $100,000 protects a couple $100,000 of my income for the year. And if I'm taxed at 38%, then that means that, let's say it was $100,000, you essentially only invested $62,000. So for easy math, let's just assume that some investment is only predicted to give you a 20% return. Well, if you only invested $62,000, now your $100,000 turning into $120,000, you've almost doubled your money. Where for a normal person, you've only gotten a 20% return. Well, for you, you got 100% return because you went into it in a very tax efficient fashion. And that's just using one tax strategy. If you had another strategy that allowed those gains to grow within a tax protected account, or that allowed you to take those gains and put them into another investment, then that would be something else you could stack on top of it potentially. We didn't do that for that deal. The other investment was a real estate multifamily deal. I purchased 50% of the building. One investor took the other half. And then we did a cost segregation study, which is nothing super sexy or radical in itself. But the other investor did not need the bonus depreciation write-off from the cost segregation engineering study. So we got the study done with a group that we've used for 2 or 3 different studies now. And then we have updated our operating agreements and worked with tax experts to document everything the right way, but we've changed the profit loss provisions so that the other investor was compensated, but I get to take the full depreciation for 100% of the property, even though I own just 50% of the property. And so the takeaway here is that on a deal, you could have 20 investors that don't need the depreciation, and you could have 10 investors that do need it, and both can be happier if you structure it so the ones who don't need it get compensated a little bit for giving it up, and the ones who do need it get something super tax efficient.
And when will an investor need or doesn't need tax depreciation?
Sometimes if they are a foreign investor investing in the United States and they're in a low tax country, sometimes if they're investing capital through a retirement account that's already able to grow tax-free or is tax protected, sometimes it could be a domestic investor who has a sophisticated strategy of earning money within a holding company in a international domicile, and then that money in that domicile is being invested in a deal, and until the point they take that money out, 5, 10, 20 years from now, there may be a way that they're growing that tax-free. Those are the 3 times that I see that most often. But the best part about your question is really interesting. It's that why wouldn't everyone who puts together any deal do research and make it highly tax efficient? Because the best investors are investors who have money to the point where they care about paying taxes. So if you're only trying to attract people who don't need tax efficient investments, you're talking about 8 to 15% of the total investor pool that might be one of those 3 categories I just mentioned. Or you're just talking about investors that are just barely accredited investors, and the largest amount they'll ever invest in any deal is $25,000, $75,000, or maybe their biggest investment of the year might be $100,000. If they're worth only $1.2 million or $1.3 million, they're not going to be investing $500,000 typically in a deal. So I think this is such an overlooked area for every single person who raises capital for anything. But also investors need to know where the low hanging fruit is and what are the 25 tax strategies and pieces of the tax code that they need to always be keeping in mind. So I found that last year, my clients were texting me, emailing me, calling me, asking me a lot of tax questions, a lot more than the year before, as Biden looked like he was going to be coming into office.
Right.
So we're conducting these 100 tax expert interviews this year. We've done about 40 of them so far. And we're doing it to just selfishly to learn a lot myself, but also to share that with people in the Family Office Club and with professionals like yourself, and just to structure deals to be more efficient.
Yes, it's very timely, actually, because of the Biden administration has said that, in fact, they are going to be increasing taxes. So everybody, all investors are interested, of course, in maximizing and keeping the highest possible return. I'm finding that a lot of my clients, I have a lot of international clients, and they create LLCs outside the United States, and then they invest in real estate here and globally. So, again, to maximize the overall return. You were talking in one of your writings, you were talking about simple versus complex, low risk approaches to tax planning. Could you elaborate a little on that?
Yeah. So what I find is that some people, probably 15, 20% of people who hear this conversation, who may have already turned it off because they dislike the topic, 15 or 20% of people say, oh, well, I want to pay my share. I don't want to get in big trouble for not paying my share. Well, if you don't follow any strategies, you're just paying double your share, because most people, at least who are in the United States, do know the tax code enough to know that you can write off some of your meals and entertainment, or you could write off your corporate car lease. And in different countries like Singapore and England, there's different tax rules, of course, by country. But some of these rules are very simple, and every business person does them and doesn't think that they're manipulating the tax code. Same with retirement accounts, putting money into an IRA or the equivalent in Singapore or London, etc. So when you look at all the different tax experts that we're interviewing in the full spectrum of tax strategies, there are things that are just as conservative and easy and relatively low risk as writing off meals or funding a retirement account. And then there are things that are in the middle, and there's a few things that are either highly complex, so they're viewed as more risky, or they are a bit more risky because the IRS has tried to, ding a few people with their hammer on it. Whether or not they've been successful, people don't want the IRS swinging their hammer at you. Right. And so as you learn all these strategies, it'll be mostly intuitive, but also you can ask 3, 4, or 5 different tax experts you may know, where is this on the risk spectrum, and what is the risk? What is the worst case scenario? And it's not like every single strategy is high risk and is going to put you on a radar of doing something manipulative. It's there's like a full spectrum of strategies to consider.
Yeah, and working with a CPA that knows about the rules and what's allowed within the tax code, approved tax code, I think that's an easy way to, again, maximize overall returns, which is the objective of every potential investors. A lot of my clients that are international, of course, they are able to deduct even your airline tickets as they come into the country, and just there are a lot of simple kinds of things that you were talking about earlier that is so much easier to, and there's a sort of a low-hanging fruit whether you take advantage of taxes. So good. So I was, do you have something specific about the new administration that you are concerned about?
Not concerned. I think there'll be an opportunity. Those who can adapt the quickest and be the most agile will be rewarded with those results. So Biden has threatened to get rid of 1031 exchanges or limit them.
No, that's a big concern.
That would be a big blow. I don't think that's going to be allowed to happen. I do think that capital gains tax rate and corporate tax rates will go up. I would bet a little bit of money on that. But also, I would look to the good things he's doing. So Biden is looking to add more green energy credits, credits related to solar. He's also looking to create something, I think he's calling it the America First tax credit. And it's basically favoring minority and women owners of businesses and manufacturing businesses specifically. And we own just under 20% of a bath salt manufacturing company in California. And so I'm looking at this and saying, okay, well, what is he changing for the good? What tax credits is he adding? Right. And looking at how that could be, taken advantage of, and looking at it as a positive thing. I think every time that things change, there's people that complain and do nothing. There's people that don't complain, but they just do nothing. And then with every change comes opportunity, and the people who are anticipating that change as an opportunity, instead of just complaining about it, I think is the way to act, whether it's a pandemic or Biden being elected or something else happening. Most change can be taken action on to turn it into an opportunity.
Actually, that's a very refreshing way of looking at it, because all I hear about the new administration is, oh my God, we're going to be taxed to death. But he's also bringing a different point of view when it comes to, businesses and promoting different segments, such as the environment, as an example. So our advice for investors will be to look into those areas and look at the opportunities that represent.
Right.
So,
I don't remember the exact quote, but I know there's a serenity prayer about, focusing on things you can change and not things that you can't change, and having the wisdom to know the difference. And it's like,
right.
At this point, are we going to change what his policies are as a single individual? Are we going to change that he became president? No. So if you want to spend your life complaining, like, you just lost part of your life, basically, right? So,
Right, exactly. So always try to, adapt. Adapting,
right.
the survival really is through adaptation, right? And we're very good at
Sure.
that. So we're encouraging people to look at the new administration with a positive outlook, and to look at the opportunities that the tax codes and the new changes in the taxes are going to bring. We
Right.
are hoping, being in real estate, we are hoping that the 1031 exchange will continue to
Yeah.
continue to become effective, because over the years, they have always been concerns about, will that be deleted, will the opportunity stop? But like you were saying earlier, there are too many people who benefit. I mean, I have people who've their net worth is about average, and maybe they have a building that they have had for years, and all of a sudden they decide to stop being a landlord, and instead they just sell that, take advantage of the 1031 exchange opportunity in terms of saving taxes or postponing taxes, and so take advantage of that. So it's not necessarily for the very wealthy. I mean, this is for, I think, average America, middle income America. So.
Right. No, for sure. And I think that, if it does go away, it will change dynamics in the market. And again, whoever can adjust to those dynamics fastest and best will win. So it might change pricing of certain assets. It might change the demand for other ways to protect your gains, like opportunity zones or something else that would allow you to take those gains and protect them and reinvest them in something else, or something else that just provides you with a large loss that could be counted against your real estate gains, even if it's a non-real estate loss. And how can that be done? So the other thing I wanted to mention is, like, I'm not a CPA and I'm not a tax consultant. I don't charge anyone for doing tax consulting. So it's not a big pitch to put me on retainer. It's not an option. We just give this information away for free as we're learning, and just kind of, we're basically a construction worker directing traffic to different tax experts. We're not the actual tax experts ourselves, but we've been interviewing 40 of them so far and learning a lot along the way. So I appreciate you having me on here to discuss it a little bit, because I find most people don't talk about it enough.
Yeah, no, absolutely. And the whole idea of the podcast is really to provide information, to continue to educate people. So that's our, that's pretty much what we do. We provide information for people to be able to, look at other venues, or to become more knowledgeable about a particular subject matter, to be able to give them a very clear understanding, a more clear understanding of areas of concern that they may have, or at least direct them in the right individual. So we are not giving tax advice. We are exploring different avenues so that you can discuss that with your CPA, depending on what areas of concern or opportunities you may want to pursue. Changing the topic just a little bit, Richard, tell us about, when it comes to raising capital for projects, for instance, how can entrepreneurs raise capital without having to giving up equity in a project? Could you tell us a little bit about some of the deals that you guys have helped us structure?
Yeah, we've done 6 or 7 deals like this. So one of them ways could be, if you have an investment project that produces very consistently 8 to 11% returns in terms of an equity investment you've made as a principal, and it kicks off 8 to 11% cash, you may be able to structure a deal where you give investors a 6% return plus their principal is being paid back, or 5% plus their principal being paid back. And you could shift up that number you pay investors if your returns on cash flow are higher. Maybe you can pay out investors 7% and structure it as debt. And then that way you've acquired an asset using debt. And if the property is paying them off, once they're paid off, you own the whole asset versus splitting that equity with somebody and splitting that upside. The other way is for a private operating business. If a CEO of a company is raising capital, like I'm flying to go see one on Tuesday, they were going to give away 5 to 10% of their company to raise the capital. We're helping them structure a deal where the investor gets a gross revenue royalty off the top line revenue of this company, doing $8 million a year in revenue. And then they also get a very tax efficient investment. So they get to write off and protect 100% of the income that they're actually investing for that amount. So if they invest $400,000, assuming they have the right criteria under the eyes of the IRS to use this type of depreciation, then their $400,000 of their income would be protected that year. If they're in California, taxed at close to a 50% rate, that saves them almost $200,000. So if that investment is structured to give them a 1.5 times return, their $400,000 investment will get paid back at $600,000. But since 50% was their tax rate, when they put in 400, they really only put in $200,000.
Right.
That 600,000 is a tripling of their money. And the CEO didn't give away 10% of his company. He gave away 0% because no one else is offering that 100% tax protection within an investment that's secure like that. And so there's all different ways of getting that done that are relatively simple. And I think that that's a big part of where we're focusing our energy going forward. And, we don't have a single deal right now that we're raising capital for. We're structuring 4 or 5 different deals right now, but, nothing we mentioned is like a big pitch to invest right now. It's just examples of deals that we're working on and we have closed recently.
Right. And no time is short with us today. So I'm going to close by asking you to tell us a little bit about the upcoming real estate investor summit that is going to take place on March 31st. Tell us about it and how can people, sign up for it?
Yeah, sure. I'm happy to. Thank you. The Family Office Club is operated on familyoffices.com, but we also spent about $500,000 to buy commercialrealestate.com this last July. And our quarterly real estate events focus on not only having real estate investors on stage, but focusing on how we can help participants get done more real estate joint ventures. And what's referred to in the industry by sophisticated investors is a real estate co-GP investment, which basically means like a real estate joint venture between 2 sponsors or an individual and a sponsor or a developer. So if you want to learn more about this event, it's going to be a 5-hour virtual event. We'll probably have 200 to 300 professionals on there, 25 speakers on stage during the 5 hours. It's very fast moving. We're going to have a discussion panel on tax strategies during that. The rest of it will be on sourcing deals, investment strategies, what's working for people in the market right now. And if you want to register for that, you need to be a member of the Family Office Club, which takes just $1 if you want to test drive it and attend an event and see if we're for you. And you can sign up for that at familyoffices.com/join.
Thank you, Richard. And thank you, the audience, for tuning in to the Financial Legacy Podcast here with me, Maria Ellis, and our guest, Richard Wilson from familyoffice.com. Thank you again for the opportunity of sharing some tax strategies and investment structures with our audience. And I look forward to more interviews as time permits.
Yes, thank you, Maria. Appreciate it very much. And if anyone has questions, my email is just richard@familyoffices.com. Happy to answer any questions they have. Thank you.
In providing answers, neither Maria Ellis nor the Financial Legacy Podcast and guest speakers are acting as certified financial planners, advisors, certified financial analysts, CPAs, economists, accountants, or lawyers. Neither Maria Ellis or the Financial Legacy Podcast and guest speakers make any recommendations as to any specific securities or investments. All content is for informational and general purposes only and does not constitute as financial or legal advice. You should consult your own tax, legal, and financial advisors regarding your particular situation. Neither Maria Ellis nor Financial Legacy Podcast and guest speakers accept any responsibility for any loss that may arise from accessing or reliance from any information in this podcast. And to the extent permitted by law, we exclude all liabilities for any loss or damages derived directly or indirectly arising from the use of the information.